Thank you, Richard, and thank you. I think it would be fitting if I opened this evening with a quote from a famous thinker, famous philosopher of life by the name of Lenin. No, not Vladimir, John Lennon of the Beatles. It was John Lennon who said, "Life is what happens while you're busy making other plans." Well, John, no, as events of the past year have shown us, life is in fact what happens while you're busy waiting for the next damn catastrophe. What is the next shoe to drop, do you think? There is a long list of candidates. Is it commercial real estate? Is it residential real estate? You know, according to Deutsche Bank, half of all mortgages are going to be underwater by 2011. Can that be true? Have we been that stupid? Is it going to be the banking industry, the FDIC, the FHA, state budgets, the retail industry? We're walking through a minefield here. Any one or more than one of these could blow up in our face. Unemployment, business and consumer confidence, a monetary crisis, the expiration of quantitative easing, we know that's coming. Interest rate pressure, stock market pressure. I mean, there's a lot of things to keep you up at night if you want to worry about it. But the point being is that this is going to leave a mark. That the reverberations from the Great Recession of the late double noughts, or as I call them, the uh-ohs, are going to be with us for a long time to come. And as someone in the forecasting business who did not foresee the breadth, the depth, the severity, or even the likelihood of these events, mea culpa. My bad. I'm sorry. You know, the biggest mistake I made is I thought the rocket scientists on Wall Street knew what they were doing. I thought the spreading of risk was a good idea. I thought that was a safeguard, a strength. It turned out to be a weakness and a threat. So I'm more modest now. And you don't have to listen to anything I say tonight. On the other hand, the forecasts I'm going to share with you tonight are not based on the simple extrapolation of past and current trends. They are based on the concept of TINA, T-I-N-A. There is no alternative. Or what must happen, given the inexorable, ineluctable forces of demographics, economics, and mathematics. Now, as Richard said, I'm going to talk about four areas: about the economy, about retirement, about the workplace, the workforce of the future, and about the consumer. Spend about 10 minutes on each, and we'll have time for questions and answers afterwards. So first, the economy. What can we expect to see? Well, I've got good news, I've got bad news, and I've got ugly news. Concerning the economy, there are still some very good positive things we can say with certainty about the U.S. economy going forward. First of all, the U.S. will still be the world's largest economy, the largest producer and consumer of goods and services, the larger exporter, largest importer, largest domestic market. Size counts for a lot. It means that there is a certain floor under which economic activity cannot drop. So that's important. And although our dominance over the world will shrink, our leadership position will not. The dollar will be challenged, but it will remain the global reserve currency. There simply aren't any other alternatives. The same is true for U.S. leadership in general, which is to say slightly diminished, but not ended. And on these points, I recommend a book called The Next 100 Years by George Friedman, rather. I would love to read a book by George Foreman, however, on the next 100 years. George Friedman runs a website called what is the name of Speers.com, really excellent. And he agrees along these lines of the next 100 years that the U.S. is still going to be the leading power. Other countries are catching up and closing the gap, but the U.S., because of its strength and its size, its military power, will still be the leading nation on earth. I mean, consider the numbers. The United States, with a gross domestic product of $14.2 trillion, is more than 3 times the size of the next biggest economy, which is Japan, at about $4.3 trillion. And the United States produces $10 trillion more per year than China's 1.3 billion people, every year, year after year. So no one is going to close that gap for the next 10 or 20 years at least. As for Europe, the 27 nations of the European Union do have collectively a GDP larger than the United States, but they're not, they are, I would not call them economically integrated. They've been trying for 40, 50 years, and they're still trying. So the United States, the economy has a lot going for it. On the other hand, wait a minute, don't let me go there yet. Let's talk about some more good things. Let's talk about the fact that the United States is going to remain among the most competitive in the world. We're not the most competitive anymore. We were up until the year before last, according to the OECD, but we're still among the most competitive. We're going to remain the most technologically powerful economy in the world. U.S. firms remain on the forefront in technological advances, especially in computers, both hardware and software, medical devices, aerospace, military applications. The U.S. also, importantly, is going to be the only advanced, industrialized economy that is growing in population and in households. That's important. The population growth is a source of economic growth in and of itself. And we're the only country that is growing. Other countries are, well, you know, birth rates are down all over the world, in some cases dramatically. But here we will be growing, and that's important. We will remain the most innovative economy in the world, and business investment will again pick up, and profits will again resume once we're out of this downturn. So there are some good things to look forward to. On the other hand, there are some bad things that are inevitable. One of them is higher taxes. It can't be avoided. We have debt service to pay for, and we have entitlements to pay for, and these two things we cannot get out of. And it's going to be very hard to grow the economy fast enough to overtake these trends. Now, I know you might say, what, if we raise tax rates, tax revenues might decline. I know, but the Dems is in, folks. Taxes are going up. That's for sure. That also means we're probably going to experience slower growth. You know, we've had a great run. We've had a great 20-year run. From 1987 to 2007, the nation's economic output expanded by about 3% a year. That now appears unsustainable. I mean, two of our greatest engines of growth in the past 20 years have been consumers. 71% of GDP is accounted for by consumer spending. They can no longer spend more than they earn. And another engine was the financial sector. Well, that's ending too. The financial sector, just like Peter Pan left Never Never Land, the financial sector is leaving Lever Lever Land, where leverage of 30-to-1 became commonplace. I don't think those days are coming back, although we're not sure what they're doing with the money now, are we? We're also going to see, almost inevitably, higher interest rates. I mean, interest rates have stayed incredibly low for an amazingly long time. Mathematically, that just can't continue. In fact, given the growth of our national debt, some economists are predicting that we could be headed towards both high inflation and higher interest rates.